Welcome to Financial Discretion Advised. I'm Tyler Hafford. I have brought back portfolio manager at Penobscot Financial Advisors, Sam Chaplin. Sam, how are you doing today?
I'm doing great, Tyler. How are you?
I'm good. I'm good. Thanks for joining us again. Bringing Sam on to talk about a topic, one that I'm really excited about. I'm excited to learn a little bit more. You know, I have a kind of a general understanding, but really excited to pick Sam's brain on the impact of the dollar on the markets, right? And we've heard a lot about this in the news this year. So we're gonna kind of pick Sam's brain on that topic. But before we get started, I have some very important questions that I need to get out there and really open Sam Chaplin up to the world. Sam, first question for you: favorite winter activity?
Oh, okay. That was an easy one. I thought you were gonna hit me with something hard. I'm a big snowboarder. I spent a lot of time up in Sugarloaf. That's definitely my favorite. But getting into some ice fishing too, maybe a snowmobile in the future at some point. But only so much time. I'm a big winter guy. I like the winter.
Perfect. And anyone who may have missed the news, Sam has bagged a over 200-pound deer, right? It was
202.
Yeah. And first time ever going out hunting, right?
Yeah, first time ever. Might retire now. Just give all my friends tips on how to be good hunters, even though I had no clue what I was doing. But it worked out.
All the lifetime hunters just shut this video off.
Yeah.
All right. Favorite holiday dish?
Ooh, okay, that one's kind of tough. This might be kind of a hot take, but I think I'm gonna go with green bean casserole, actually, just because I only eat it once a year.
Yeah.
So yeah, I'll be unique there.
Interesting. Wrong answer, but
yeah, that's divisive, very divisive dish.
All right. Are you a good gift wrapper?
Ooh, interesting. So my girlfriend thinks I am for some reason. I didn't think I was, so I had to put some extra effort into it this year to try to be better about it. I did have one gift yesterday that it didn't quite make it all the way around. So there's a little bit of cardboard sticking out there, but you just position it right. It'll work out.
Yeah, you put a nice big bow on that area and you're good to go.
Yep.
I'm very happy with the invention of the gift bag. Very good at those. So
yeah, that's a good call.
All right. And this was a question I asked Libby when I had her on for the recession podcast. I'm going to ask you this. I'm giving you $1,000. It's the only money you have to your name. You can't be a good financial planner and put it in a savings account. You can only buy a stock or a bond. Which one are you buying?
Do I have to pick a stock or say stock or bonds?
No, okay. We're just buying equity and fixed income.
Gotcha. I'm buying equities for sure for the long haul. That's where it's at. I get a long time horizon. You know, if I was going to retire the next couple of years, I might think about bonds, but I'm not there yet.
Like the risk taken.
Not quite yet. Maybe 3 or 4 years.
Perfect. All right. Well, let's dive into it, Sam. So like I said, I'm really excited to hear your take on this. Can you kind of walk us through what the impact of the dollar strength or strengthening or weakening of the dollar and what that impact has on the broader markets as a whole?
Yeah. I think I'll probably back up one step and, talk about what it means for the dollar to be strong. I think there's probably a lot of people out there that have been going to the grocery store lately and thinking their dollar doesn't feel very strong. So a lot of people keep saying that. But it's a different topic than inflation. When we're talking about a strong dollar, we're talking about, how much of foreign currencies can a dollar buy? So it's really about a globalized economy. If you're buying products coming from Europe, those are denominated in euros. A few years ago, you might have been paying $1.30 to get a euro, and now it's like 1-to-1 because the dollar's gotten so much stronger. What that really means overall has a lot of good and bad effects depending where you are and what you're buying. If you're buying totally U.S. products with U.S. dollars, doesn't make a big difference how strong the dollar is. But when you start crossing borders, people and products crossing borders, it starts to matter quite a bit. So some of the effects the dollar has had by getting so much stronger is that imports have gotten a lot cheaper, right? So $1 goes a lot further overseas. So that means we're buying a lot more stuff from overseas. But on the flip side of that, our exports have gotten a lot more expensive. You might have heard the term that US is exporting their inflation to the rest of the world. What that really means is because the dollar is so much stronger, it costs more in foreign currencies to buy U.S. products. So that causes kind of an imbalance. We're buying more products abroad. Buying more products abroad and less products being purchased from us, which has an actual negative effect on GDP since less things that we're producing are being purchased. So those are some of the effects throughout this year. Strong dollar is actually, nobody's going to believe this, but it's actually helped keep inflation down a little bit, because those products that we're importing, those prices are lower. So we're exporting some of that inflation through our exports, but we're importing lower prices because the dollar's stronger. And you think about, like, gold or oil is denominated in dollars. So you can think about the dollar as like a unit of measurement. As that unit of measurement gets bigger or stronger, the price comes down. As it gets weaker or shorter, the prices go up. So those are some of the effects. And so far this year, it's been quite an epic rally in the dollar so far. We have seen it come off a little bit over the last few months. And a lot of reasons for that: supply and demand, differences in interest rates, creating a lot of demand for US dollars.
Yeah, so that's a good point. So this rising rate environment that we're in, that the Fed's kind of manufacturing for us, that in itself is strengthening the dollar, or it did through the year. Does that have any kind of correlation?
It does, in that kind of demand function I was just talking about of, say you live in Venezuela or, Argentina, somewhere with a really high inflation. There was, our inflation's around 7%, theirs is around 100. So they're saying, why am I going to keep my money in my local denominated currency? Let me go put it in these US dollars instead, because it's going to be much more stable. That type of thing creates a lot of demand for the US dollars. Also, as interest rates go up, as you were just mentioning, it makes the US dollar more attractive. It's a very stable currency. You can be very sure or pretty sure that you're going to get your money paid back on it. So as US interest rates go up, that creates a lot of demand for the dollar as well.
Okay, and that just put a lot of pressure on what was already a tough market, right? So
Yeah.
So
If you actually look at US interest rates and, the value of the dollar, they move pretty closely together. And when I'm talking about the value of dollar, we're talking about the dollar versus a basket of foreign currencies. So there are indexes out there that'll say, an average of how much of these foreign currencies a dollar could buy.
Right. So in real terms, not helping us at the grocery store, but if an American is going grocery shopping in Italy, it is helping us, right? Our currency is stronger, can buy more overseas.
Yeah, absolutely. Great time to be traveling in Europe right now. And then, of course, it all goes two ways. And the flip side, it's a bad time to be traveling in the US. So it hurts our tourism industry a bit.
Gotcha. So, Simon, you may not know this off the top of your head, but had the dollar been strengthening coming into this year, or is that just kind of a phenomenon that we just really saw this really big kind of push up that really kind of tipped the apple cart?
Yeah, it's been kind of a slow and steady uptrend in the strength of the dollar, but definitely shot up, very dramatically over the past couple of years. Part of the reason for that is, over time, dollar has been becoming what's called the world reserve currency. It's kind of a way of saying that it's one of the most stable and strongest currencies out there. So if your currency is not so strong, it's a good place for you to go. Fairly much of a safe haven for you to put your dollars. And that effect has helped the dollar over the past couple decades at least. And even, like, you could think it's some emerging market countries, developing countries that have very volatile currencies will actually denominate their bonds in dollars, because it's, you don't want to have to deal with all those currency fluctuations when you're worried about paying your debt back. So that type of stuff creates a lot of demand for the dollar. And oil's denominated in dollars. A lot of this stuff has caused a lot of demand for the US dollar, made it stronger.
Yeah. And so prior to coming into this year, right, we're talking about trades and imbalances of what we're buying and selling. We were coming out of a period where there were starting to be lots of trade wars. Did that have any impact on kind of rising up the dollar? I know you said for the past couple of years we've seen this, or does that kind of just stay pretty much unaffected when we start meddling with the global trade?
I'm sure it has some effects. I couldn't put my finger on what exactly the effect is. Depends on each situation. But yeah, it is a free floating free market where I think the global currency market is the biggest market in the world. I actually just looked it up. So US, or the global stock market, is $111 trillion. The currency market is $2.4 quadrillion, which sounds like a made up number. But it's like $6 trillion a day is traded in it. It is all free floating. There are a few countries that have different regimes of how they handle their currency. But I just think it's fascinating that the value of the dollar is changing every microsecond, open 24 hours a day of trading. So yeah, it's an interesting market.
And so this year, seeing this pull up in the dollar, obviously the markets had a really rough year. You talked about kind of a reversal here at year end. The dollar's starting to weaken a bit. is that correlating with kind of a move up in equities, or are they starting to kind of behave differently? It seems like we had a bit of a rally here coming to the end of the year, which is starting to show some cracks here as we get closer to the end of the year.
Yeah, definitely some correlation there. And like I was talking, it has a lot to do with interest rates. As those inflation numbers have come down, interest rate numbers or interest rates have come down a little bit as well, which is made the U.S. interest rates a little less attractive versus the rest of the world, caused some people to pull their money out of the dollar and weakened it a little bit. That's kind of where we're at now.
Is there like a happy medium of where the value of the dollar should be, in relation to the rest of the world, which kind of keeps markets happy, keeps us happy, just kind of like an equilibrium out there?
Yeah, I don't know if you could put a number on it, but just stability. I would say people don't think about currency in the investment markets too much because under normal circumstances, they're not fluctuating enough to really mess with your returns at all. It's when these type of crises happen that big fluctuations happen. So really the happy medium is just stability.
Stability, yeah.
Yep.
Markets like when they can predict things, right? And
yeah, exactly.
Makes that easier. Well, great. Anything else on the dollar that we haven't talked about that you think that's important for investors to know before I kind of move to the next piece?
Not that I can think of at the moment. We hit on how it affects exports and imports and GDP, tourism. Emerging markets get hit particularly bad when the dollar gets stronger. It's generally right now good for us, bad for everybody else at the moment.
Yeah. And do we think, or do you think the consensus out there is that the dollar will continue kind of this trend downwards from where the peak was a couple months ago?
Yeah, that is kind of the expectation over the next few years. We could get another bump up here in the near term, but that's what tends to happen after these type of crises is we get a big spike up and then a little blow off that it comes back down to normal levels.
Interesting. Great. Well, I want to finish today's show picking your brain on what you think is something that's really important to focus on as investors in 2023, right? We just had this really tough 2022. We had a lot of things going on. Interest rates are going up. Inflation has kind of dominated the news. We're talking about recession. You are living in this world. Every day you're looking at portfolios, you're trying to position us. What are you kind of keying in on for 2023?
Yeah, so now that the inflation numbers are coming down, the big disconnect or controversy part for next year is there going to be a recession? And if so, how deep is it going to be? The market's saying the Fed's going to keep hiking interest rates for another few months, and then they're going to stop, and then we're going to be hitting a recession. So the Fed's going to pull the interest rates down. The Fed's saying, no, we're not. We're going to keep them higher for longer. This is, a totally new world, new regime we're living in. So which one of those wins out will be very interesting. So far, the market's actually been pretty right about the path of inflation and whatnot. The Fed kind of needs to keep a hard line right now because if they said, hey, we're going to pull down interest rates this year, the market's going to go buck wild and then inflation's going to pop back up. So it's kind of a self-fulfilling prophecy if they do that. But the big question is, how deep is the recession? I think if we get a short and shallow recession, the Fed's going to be able to keep those interest rates pretty high. And then we're not going to get those big return on bonds that we would expect if those interest rates did come back down. If we do hit, a very kind of deep, dark type of recession, the Fed is going to have to pivot and those bonds are going to do really well. So the big question for 2023, the consensus is growing that we are going to have some type of recession. But the question is, how deep is it going to be? If you believe that it's going to be deep and dark, bonds is a great place to be. If you think it's going to be shallow, bonds are still a good place to be, but not as good.
Not as much. So yeah, it's kind of is this going to look like the 90s or 08, 09 kind of scenario, right? And to your point, Sam, if you kind of look at a graph of interest rates and recessions, the Fed tends to cut when that happens. And I think Jay Powell said in one of his recent kind of speeches, I can't remember which one, but he said if we do see an extreme contraction of the economy, that the Fed would use all the tools available to help rescue the economy. And essentially what he's telling us is they'd cut rates, right? So
yep.
You are getting a lot of harsh rhetoric out of the Fed on purpose, but they are acknowledging the fact that maybe a change in policy would be needed if they do over tighten. Just interested on that piece, Sam. I know it's kind of outside of our conversation today, but do you feel like the Fed is getting to a point where we are over tightening too much, or do you think that the rate that they're kind of targeting makes sense for what they're trying to accomplish?
Yeah, that is the big question, and I don't think anybody really knows the answer to it. It's kind of interesting actually that when you hike an interest rate, the amount of time it takes for that interest rate to really bleed through and change things in the economy is pretty unknown. They say it's something like 12 to 18 months. They call it long and variable lags on the impact, which is pretty much a fancy way of saying that they don't know how long it takes for it to impact the economy. So we've done a lot of hiking that is yet to catch up and actually be impacted into the economy. We are seeing a lot of those really interest rate sensitive sectors of the economy, like housing and autos or whatnot, have been pulling back. The problem is that it's now gotten into some of those non-sensitive sectors of the economy on the services side in particular, where hiking interest rate isn't going to lower your grocery prices or anything like that. So that's where the pain's being felt at the moment. I think they're actually in a pretty decent spot right now. I think the 5% level that they're talking about getting to makes a lot of sense. Historically, we haven't been able to get inflation down without getting that Fed funds rate above the CPI inflation rate. So this would be the first time that happened if we did do it, unless inflation comes down a lot faster than expected. So by historic means, they're still like a little bit conservative even. It's the rate of the hikes that they've done so far that is new and interesting, that this is the fastest pace of rate hikes in a long time. So that means it's going to be a lot of impact hitting the economy over a short window of time. So that's very difficult to predict because you're using last month's data on inflation to try to predict where you're going to be in 12 to 18 months. It's a very difficult thing to do.
Yeah, I don't envy their job. And just kind of a historical perspective, we did go through 70s and the 80s with tons of rate hikes, pushed us into a decent recession in 81, 82. We've done it in the past. I think the 90s was a little softer. But to your point, I don't believe we've ever had inflation go above 5% and come back down without a recession. So probably the medicine economy needs. Well, Sam, I want to thank you for coming on. Every time I talk to you, I learn something. It's fantastic. If anyone wants more Sam Chaplin, and I understand that that's probably a hot commodity, Sam does a lot on our social media. He puts out great charts that kind of explain things that are happening in the market today or the housing market and things like that. Check those out. And Sam and Jim Bradley, the founder of the firm, do a market commentary every quarter where they dive into a lot more of what we just talked about and how that impacts the market. So make sure to check that stuff out. Please like and subscribe down below so you don't miss any of our content. But Sam, I want to thank you for coming on. This was a great conversation.
Yeah, anytime. Thanks for having me, and happy holidays, everybody.
You too. And if you want to revise that green bean casserole thing,
Will do.
Bye.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Thank you.